when I started in this business, one of my very first clients was a gentleman called Kliff Notes, who said, Louis, it's an easy business. You have to remember that, when things go bad, when the proverbial brown stuff hits the fan, and you don't know what to do, the Fed will always follow policies for the benefit of the equity holders, because 70% of Americans own stocks. So, in a bind, you buy US stocks. Meanwhile, and this is where I show my age, he said, the Bundesbank will always follow policies for the benefit of the bondholders, because in Germany, everybody owns bonds and nobody owns stocks. So he said, when you don't know what to do, you buy bonds in Germany and you buy stocks in the US. And frankly, if I followed that advice, I'd be a wealthier man today. But what happened, of course, is that in 2011, we found out that the Bundesbank no longer existed. I think there was this sort of hope or belief that, the Bundesbank had been merged into the ECB and the ECB would be the new Bundesbank. When everybody realized that wasn't the case, the euro went from 150 down to parity. But there is a new Bundesbank in the system. The new Bundesbank is the PBOC. And, I've argued this in piece after piece. I've argued this in my books, that if in the US, the way policy works is, first, we must make sure stocks do well. We must make sure the bond market is stable. And then the currency can settle where it settles. We don't really care. As John Connolly told the Europeans, the US dollar is our currency and your problem. In China, that order is reversed. First, they care about the currency. Then they care about the bond market. And then the equities can settle where they settle. We don't have to care. It's the remnants of what sticks. And so if you look at the past 10 years, US stocks have crushed Chinese stocks, and Chinese bonds have crushed treasuries, absolutely crushed them on a 1-year basis, 3-year basis, 5-year basis, 10-year basis. You take any period that's more than a few months, and Chinese bonds do better than US treasuries. And so this is always what I say when people ask me, hey, is China investable? For bonds? Absolutely. It's been the best major bond market in the world. For equities, well, equities are the variable of adjustments. They are the bottom of the pecking order, and you really only buy equities. So it's a long-winded answer to Keith's question. I apologize, but equities in China tend to be always more of a trade than a buy and hold. And you buy them when the government steps in to say, you know what, we want equities to go up. And that's exactly what they're doing today. They did this in 2003. They did this in 2008. They did this in 2015. And when they do, given the amount of cash that there is in China, the savings, the fairly low volumes, and the fact that once they say this, nobody wants to sell, what ends up happening is the market can go up 100, 150% over 6 months to 2 years period. Then typically the government comes in and says, okay, that's enough of a party, fini. They crush down on margin debts. They pull the rug, and then the market goes down 50%, and then you do nothing for 5 to 10 years. So for me, the big question today is, have we started a period where, are we 25% up on a 100% move? And I'd answer yes. I think we are 25% up on a 100% move.